Inflation in the United States eased slightly in the year through April, slowing to 2.3%, the slowest annual rate since early 2021. Let's get more from Andrew Szczurowski, portfolio manager at Morgan Stanley Investment Management. Andrew, thanks very much indeed for joining us. I know any macroeconomic numbers right now feel a bit like the calm before the storm because we haven't seen the impact of tariffs, yada, yada. But can you tell us what jumped out for you with these latest inflation numbers?
Yeah, sure. First of all, thanks for having me. This was a report that some were expecting to start seeing those early signs from tariffs pulled through to inflation. We certainly didn't get that, as you mentioned, kind of lowest inflation report over the last couple of years. And we could see that the report was trending in a direction that would have allowed the Fed to cut rates over the short term. As far as what stuck out in the report, I mean, one of the things was that we were expecting a price hike in kind of used and new autos, and that's something both those sectors declined. You saw transportation prices, airfares decline, and that could be showing signs that the consumer, which we felt for a while, is starting to lose steam. You can kind of see that showing up in some of the demand for flights, so that was certainly something that stuck out. You also had food prices decline, so that's something that the administration here in the U.S., I'm sure, will be kind of touting as a positive sign. And on the other side, you didn't see a decline in energy prices, gas prices. That's something that, as you mentioned, oil has been declining throughout the course of the year, but we haven't seen it show up in gas prices just yet. And so I think that could be a tailwind going forward, though.
You said there was something of a surprise on used cars. Can you give us a bit more detail there?
Yeah, sure. I mean, one of the things that we saw, if you go back to the pandemic, coming out of the pandemic, was one of the big kind of price hikes we saw was actually, as they were building less autos, there was a huge demand for some of those used autos that kind of caused a big price spike. So that's something that people were expecting to start showing up this cycle as well, as you saw some of the kind of large increases over new autos over the last couple of years. And then people were expecting those tariffs to start filtering through to new auto prices. There should be a growing demand for used autos as affordability went down on the new auto sector. Now we didn't see it this report, but there was the Manheim Used Auto Index that came out earlier this month, was showing that we should be seeing price hikes in used autos. But again, we didn't see it this month. It could show up next month. So far, so good for the Fed.
When it comes to the Fed cutting rates, you reckon the thing that Jay Powell and his colleagues need to see is decisive weakness in the labor market, and that could be months away?
Yes. I mean, the Fed's at a point where, look, they lost a lot of credibility in 21 and 22 from not hiking rates fast enough and saying inflation was transitory. They've been building back that credibility for the last few years, and they've done a great job of doing that. But they're not at a point now where they want to cut rates in front of, as we mentioned, these tariffs are going to start filtering through. They want to see how bad it is and how much of that gets passed through to the consumer. I do think the consumer's in a much different state than they were in 21 and 22. And by that, I mean, in 21 and 22, there was large wage gains going through to the U.S. consumer. There was all this stimulus that had been pumped through, not to mention they had pent up savings from kind of sitting at home for a year plus during the pandemic. So I think that's it. We're in a much different state today. If you look at where wage gains are, they've been trending lower and lower for the last 2 years. So I don't think they can handle I don't think they can handle the price hikes this cycle, which means that price hikes are going to be met with less demand, which means that for companies, they're going to have to choose between kind of eating some of those price hikes from tariffs or passing them on to consumer, but with less sales in the same process. So as far as the Fed, look, I think the Fed, they want to give this a few months, see where it plays out. And then the only thing that can really kind of get them off the sidelines in the short term is a kind of pretty short-term dramatic decline in the labor market. And I think that's going to take a few months to play out as well. I do think you're going to see some of that impact of the uncertainty that there's on the business and consumer confidence front. I think that's going to show up in hiring over the next few months. And so that will eventually get the Fed off the sidelines. But I think we're probably looking at a late Q3 for the Fed to begin cutting rates.
And you think that the Fed is still above neutral with the current level of borrowing costs? It's still marginally slowing down the economy?
Yes. I think 100%. I think that's one of the things that the Fed, they had 4 cuts last year, and that was getting them closer to where they felt was neutral, but they wanted to kind of pause there, which they did. And if you look at the economy, look, we just had negative Q1 GDP here in the US. That was partially distorted by large imports and front running of tariffs there. That's going to play out you could have some of that reverse in Q2. But if you just look at the general consumer, as I mentioned, the demand has been slowing, wages have been slowing, so they can't handle those price hikes. And so if we're in a world where U.S. growth downshifts from kind of mid-twos to low mid-ones, that's not an environment where the Fed wants to be in a restrictive territory. And again, the Fed in this 4.25% to 4.5% quarter right now on the Fed funds rate is certainly well above where they think neutral is. I think if neutral last cycle was 2.5%, I think it's a little higher. I think we're more like 2.75 to 3%, but we're not in this 4.25% to 4.5%. So they have a long way they can cut from here just to get to neutral. And then there'll also be a point where if the economy slows enough, they could go through neutral. So I think that's something that when you look at where markets are attractive and where to take risk, I think keep in mind over the long term, it's where's that neutral rate and how much has it shifted?
It seems fair to describe the current administration's policies as unpredictable. Certainly the tariff barriers they've erected are, some observers say, the highest in a century. Do you think there has been and will there be a significant move out of U.S. assets because of that unpredictability?
I think it's a great question. I think it's one of the things that we've seen more recently. I think in markets, people, investors start to diversify out of U.S. assets a little. And you saw that with a weakening dollar, a lot of money going into euros and yen. And I think that there's just going to be a little more diversification going forward. I think if you're a business and you had a lot of overseas operations, you're gonna want to kind of keep some of those euros in Europe and not pull everything back here to the U.S. I think we're in a situation where there's a lot of uncertainty. It's not going to go away over the next couple months either. We've removed some of the tail risks right now on the growth and tariff front, but I don't think we've removed all of the uncertainty at this point. So I think there's going to be a lot of volatility. We saw this during the administration's first term in 16 to 20, and I think we're going to see it going forward. But there's going to be these kind of ebbs and flows. And I think you got to keep that in mind as an investor, is that we're in for a little more volatile environment, and you can take advantage of these opportunities, but these opportunities come and go quickly is the other thing for investors that's a little frustrating.
Andrew, thank you very much indeed. Andrew Szczurowski has been our guest portfolio manager at Morgan Stanley Investment Management. Coming up,